Okay, so once again, hello everybody. Welcome to SunBirdFX webinar regarding the correlation between the stocks and currencies. My name is Bastian Rubin and I'm SunBirdFX Chief Analyst. Those of you who've been in my previous webinars already know me. Those of you who read the daily analysis that is written by me is familiar with my name. Those of you that it's their first time on Sunbird's webinar, then welcome. Before I start, sorry, let me apologize in advance if English is not my mother tongue, so if I have slips here and there, I apologize that. So what are we going to talk about today? Is again the correlation between stocks and currencies, actually the stock market and foreign exchange market. Now, if you read the daily analysis, SunBirdFX analysis, you know that we start every analysis with a brief view regarding the U.S. stock market. Now, there is a reason why we always start with a brief regarding the U.S. Stock market. It is because it's very important. It has high influence on stock market, on the currency market. So basically, even if you don't trade stocks and you don't trade the U.S. indices, it's very important for you to understand and how they act these days and how to analyze them in order for you to have better or larger profits on your Forex trading. All right, so let's start from the basic. What is correlation and why it is important? Now, correlation basically, it's not from the financial world, this term. It's the general dependence relation between two variables. It can be between stocks and currency. It can be weather and, I don't know, storms, whatever. It can be anything general, two variables, and the correlation reflects the dependence relationship between them. So obviously we're in the financial field. What interests us is the correlation between instruments and how they influence on each other. So in order to analyze currencies, we need to know what influenced them. Once we know what influenced them, we can have the ability to predict or anticipate movements of a certain instrument within probability of higher than 50%. So understanding the correlation between stock markets and currency markets helps the trader to open positions in the best timing. On the end of the webinar, we will discuss how to time your trades better than you do today. All right. So, what influences currencies? First of all, the most tool that has the tool that has the most highest impact on currencies is the interest rates. This is the tool that central banks use in order to help the economy and all other elements in the economy. We're not going to get into that. But interest rates has the most powerful influence on currencies. All right, investors, they prefer currencies of high interest rates just because they can put their saving accounts in these countries and get more money back. Second is the economic situation, employment status, inflation, trade balance, etc. All these kind of economic indicators have high impact on the stock markets and currency markets. Clearly, we have the geopolitical situations in certain parts of the world. We have wars, we have crises, we have conflicts. They influence the stock market, the currency market, and actually every financial market. And the last one is the stock market, or stock markets actually, that influence currencies. And we're going to focus on this one, the stock market, and how they influence stock market, the currency market, and eventually on your trades and the money that you can gain from Forex trading. So let's make a quick brief regarding the variety of stock markets that we have around the globe. So we have the Asian stock markets. Main markets there are the Hong Kong, Tokyo, and Shanghai. So the leading indices are Hang Seng from Hong Kong, and Nikkei from Japan, and Shanghai from China. Now the Asian markets has less influence on the currencies comparing to European markets, stock markets, and U.S. stock markets. All right, European and especially U.S. stock market has much higher influence on currencies. All right, so the European stock markets, the main ones are in Frankfurt, Germany, Paris, and London. All right. So in Germany, we have the DAX. In France, we have the CAC. And in the UK, we have the FTSE, or FTSE, as they call it. Now, the European stock markets are mainly influenced by the US stock market. All right. Let's see how. Now, take a look here. On a screen, all right, we can see that the DAX is following the S&P 500. S&P 500 is an index, the largest 500 companies in the U.S. stock markets. So we can see that the DAX is actually following the S&P 500. All right, if the S&P 500 rises, then the DAX rises, and vice versa. Now, what's interesting here to see is that both indices were sliding during March and April, May, and when the U.S. stock market started to correct upwards, see what happened in Germany, and this reflects the situation in Europe, that the correction, all right, the bullish correction in Europe was not as powerful as it was in the States. And that is because the huge debt problem in the European continent. So what you need to understand from this one is that the S&P 500 or the US stock market have the highest influence on the European stock market, all right? And on this current time, the DAX is moving in much slower intensity than the S&P is. So those of you who trade the DAX, by the way, you can trade the DAX through the MT4 platform of Sunbird. Here you can see the symbol. So if you trade the DAX, you need to understand this important element, that even if you see the S&P 500 rising, the DAX won't definitely rise on the same intensity. All right, let's continue. So the US stock markets which are pretty much the most important financial market. They have the highest impact on the financial system, right? When they slide, when they fall, they impact the entire markets, currency markets, European stock markets. Anywhere in the world, investors around the world are looking forward for the performance of the stock markets in the U.S. Now we have two main stock exchanges in the U.S. First is the NICE, New York Stock Exchange. All right, if you want to recognize stocks that are traded in the New York Stock Exchange, those would be stocks with 3 letters or less, such as KO, which is the symbol of Coca-Cola, C of Citigroup, and BAC, Bank of America. Then we have the NASDAQ. NASDAQ is usually a platform for technology companies. All right, if you want to recognize a stock from NASDAQ, it will be 4 letters or more. So we have the MSFT, which is Microsoft. We have Apple, AAPL. By the way, Apple is going to publish its results for the second quarter on Wednesday, and that's it basically. We have 2 main stock exchanges. Now it doesn't matter for you to recognize stocks. There is a meaning for this difference between these 2 stock exchanges, but since we're talking about Forex, it's just general information. You don't need to know how to implement it. Okay. So there are 3 main indices in the US stock markets that we are interested in. We have the NASDAQ 100 it means that the largest 100 technology companies, all right? We have the Dow Jones, which contains the larger 30 industrial firms. All right, NASDAQ and Dow Jones. Now, usually, if you read financial websites, magazines, newspapers, they always talk about Dow Jones. What did Dow Jones do on the day before? Now, the thing is that Dow Jones is not the most important index. The most important index is the S&P 500. The reason is that it contains the larger amount of firms in it, and it's the best reflection to the U.S. Economy situation. So the S&P 500, this is the index that you want to follow. You want to analyze. All right, it's the most important index for traders. Now, usually those 3 indices are moving in the same direction. You probably won't see the Nasdaq going upwards and the S&P going downwards. All right, they usually go together, except in times of such as the result season, like the current result season, that Nasdaq and S&P might be traded in different direction or momentums, but usually they will go on the same direction. All right. So, as I said, S&P is the most important index. It's the mirror for the U.S. economy, right? Now, why it is so important? Because institutions, right, the large players, the big players, are making their decisions according to this index. If they are making their decision according to this index, you should probably know what's going on with the S&P 500 before you make any kind of decision. All right, this is the most important conclusion that you need to come up with so far. All right, S&P 500 is an important index. You need to analyze it. Okay, you need to analyze it. Even if you don't trade it, you need to know what's going on with the S&P 500 chart, daily chart, intraday chart. in order to trade currencies. So let's talk about the correlation between the S&P 500 and the US dollar. So when the stocks rise, all right, when the stocks rise, money is transferred from saving accounts and trusts to the stock markets. Why is that? Well, it's all about the alternative that the investor has. So when the stock rise and their yield is much better than putting your money on bank accounts, right? Saving accounts in banks, which give you really low interest, then you would prefer putting your money in the stock markets. All right? Because the ROI is better in the stock markets when the stocks rise. All right? So, and when they fall, it's exactly the opposite, because the ROI, the return on your investment, is lower. And so you would prefer to put your money in saving accounts. And when you put your money in saving accounts, you support the US dollar. That is why there is a correlation. This is one of the reasons that the correlation between the S&P and US dollar is negative. So low interest rates drive the markets. All right, it drives the markets, the US, the stock markets, obviously, and makes bonds and other solid investments less attractive. So if it's less attractive, once again, you would prefer to put your money in any kind of investment that will give you higher ROI. Okay. So when the stocks fall, investors prefer investing in the US dollar, because it is considered as a solid investment, although it's a currency, right? It can never be too solid. But since the US dollar reflects the stable US government, so investors tend to put their investments in the US dollar, in time of uncertainty. Okay, so to conclude, the S&P usually has a negative correlation with the US dollar and positive correlation with the euro. We're going to see how it works on charts, but what it is important for you to know, to understand on this point, that this is not a pure science. I mean, as it happens these days, as we can see, that there is no correlation between the euro and the US stock market. The euro just keep falling and falling. We'll discuss it later. So the thing is that the correlation that I'm going to tell you about occurs actually most of the time, but not 100% of the time. So you can't rely on it 100% of the time. All right, you need to understand. You need to analyze and to figure out if the correlation still exists. And if it is, you can work according to it. But if it doesn't, so then you need to change your methods. All right. So, okay. Here we can see the daily chart of the S&P 500 versus the daily chart of the euro dollar. All right. So we can see how amazing is the fact that these both instruments are moving on the same direction, changing on the same spots. All right, on the same timing, and this reflects how important it is to understand that the S&P 500 determines what is going to happen with the US dollar. Now, as you can see, well, I don't know if you can see it, but the S&P 500 is usually moving before the currency. So we will going to see that the S&P is rising, and then we're going to see that the US dollar is rising. Sorry, falling, for example. Okay? It's not the opposite way. Because the S&P 500 is pulling this pair of currencies to its own direction. So you can see the purple arrows. We can see that both instruments are traded, changing momentums on same location on the same time. All right, here, here, here. All right, and once again, as we mentioned about the European indices, we see that when the S&P 500 started correcting up, the euro dollar also started correcting, but not on the same intensity. Right? That is because investors don't want on price fortune. Okay. So as I said, there is a negative correlation between the stocks and the US dollar. All right. Someone asked, what is the correlation? It's usually negative correlation. All right. Now another question is, will Apple publications influence the stocks upward or down? Well, you can never know unless it happens. You can never know before Apple releases their results for the second quarter. So Wall Street always expect better results. Good results will probably cause incredible increase in the stock price, which will probably pull up the entire technology sector, and as you can understand, positive influence on the US stock markets and so on. On the other hand, disappointing results by Apple might have a negative influence on the US stock markets. All right, so we need to wait to July 25, which is 2 days from now. Okay, let's move on. Now, we can see that there is a strong correlation between the S&P 500 against the British pound as well. All right? So, in this case, we can see that the pound is started to slide when the S&P 500 started to fall. Now, but what we can also see here on the left side of the chart, that the correlation is not that strong as it is with the euro versus the US dollar. All right, here we can see a little bit less powerful correlation, but yet it is still very important to know what's going on with the S&P 500, even if we don't trade the euro dollar. Actually, even if we trade exotic pairs or cross pairs, we need to understand what's going on with the stock markets, with the US stock market. All right. So again, when the index is up, the pair is up. Right. When the index is up, the US dollar is weakening, and vice versa. So the conclusion is that if you know how to anticipate the movement or the momentums of the S&P 500, you probably have better chances to trade with the right correction, trade currencies with the right correction. All right? Okay, let's move on. So what happens these days is extraordinary situation, all right, in which we can see that the US stock market sometimes rise and the euro still falls. Now the reason is the debt problem in the eurozone. Okay, sorry, we had a little bit interrupt. So the crisis in Europe, all right, has high influence on the currency. Investors don't really care that the US dollar, sorry, that the S&P 500 is rising. They're trying to get rid of their investment in the euro because many of them don't believe that this current problem can be solved. And even if it can be solved, it will force very painful price from the European citizens. So the current declines that we see in the euro reflects the concerns from the European situation, and this influences the correlation between the euro and the S&P 500. This is why these days we can see. That's why today we can see that the euro is falling and it's approaching 120, whereas the S&P 500 on the bullish track. All right. So in such times, when the correlation is broken, you need to make adjustments in the market. Okay. So what kind of adjustments? All right. So if we know that there is a positive correlation these days, okay, which means that even if the S&P 500 rises, the euro falls, sorry, negative correlation, then we trade euro, we sell the euro, even if the stocks rise. All right. I hope it makes sense. It might be a little bit confusing, but this is all about timing of a trade. If you know how to time your trade according to the S&P 500, and you understand the changes in the correlation, this is the key from my point of view to win the market. Okay. So what we can see here is the actual influence of the European debt problem on the correlation. Here we can see, all right, between these two lines, that during May, all right, the US dollar, the S&P 500 corrected up, and let's see what the euro did. It continued falling, all right. These days it is much lower. It's approaching 120 or 121. So, but this is the idea. Now, those who realize that on time knew that in spite of the fact that the US dollar, the US indices, rose, the European currency would continue falling, and that gave a great opportunity to sell more euro. Okay. Now, another important thing to understand here is what's going on with the Japanese yen. The thing is that the Japanese yen, and until one year ago, this currency was considered as a let's say safer bet in time of uncertainty. All right. We'll see the Japanese economy solid. All right. And the Japanese government as liable. So when the stock markets fall, they transfer their money to the Japanese yen. And that is very important to understand, because if you understand this correlation, you can trade obviously the US dollar versus the yen, and moreover you can trade yen pairs with that have much higher volatility. All right, much higher volatility. So the point is that the yen sometimes is traded against the general trend of the US dollar. We might see the US dollar strengthening when the stocks fall, but at the same time, the JPY will strengthen as well. All right, the US dollar will probably strengthen against most of the major currency, but not against the Japanese yen. All right. Any questions so far? Good. So let's see an example of this correlation. Here we can see, all right, on the beginning of the year, that since the beginning of the year there is a positive correlation between the S&P and the US dollar yen. All right, when the S&P rose, the US dollar rose against the yen, not against all of the currencies. And when the S&P started sliding, investors transferred the money to the Japanese yen. So it's the complete opposite to the correlation between the S&P 500 and other major currencies. All right. So we have a positive correlation between major currencies and the S&P 500, but negative correlation between the S&P 500 and the yen. All right. So all of the things that I've mentioned are influencing the timing of a trade. Timing of a trade is what is the exact moment that you open a position. So when you analyze a trade and you want to open a position, you need to consider what's going on with the stock market, currency market, everything. All right. So you might have a good strategy that may work, but if you don't have the perfect timing, all right, if you don't time your trade with the momentum of the US stock markets, meaning the S&P 500, the chances for you to lose your money are getting higher. On the other hand, you may not have the best trading strategy, but if you know how to time your trade with the movement and the changes of the momentums of the S&P 500, then you might have better chances to win. So the thing is that you need to understand what is going on with the US stock markets, and then you should approach the Forex market. Okay. So how you should do it when you analyze the US stock markets, all right? When you analyze the US stock markets or the US indices, you need to look for is rising. And you can see, you analyze the chart and you see a strong resistance come. Then you know that the S&P is about to lose power or maybe make a bearish reversal. If you know that, then you can implement what you know on your position. Maybe you don't want to open the position because you know that the S&P 500 is going to change direction, and that will influence your trade, right? Maybe you will wait until the S&P will correct and then you open a position. All right. So there is a variety of things that you need to understand. You need to anticipate as much as you can, clearly, what's going on with the support and resistance of the S&P 500, and then you should approach around. That is why, once again, on SunBird's daily analysis, we always open the first paragraph with a brief review of what happened in Wall Street on the trading the day before. Sorry. All right. Okay. So the thing is, what you should remember is that trading is not pure science. I said it 15 minutes ago, and I will repeat it now, because if it was a pure science, then it would be easy to make money, right? There was no risk. But clearly, it is not a pure science. So correlations tend to change. You need to spot when they are changed. And if you have the ability to spot that, and if you have the ability to understand what is the current correlation, then your trading skills are much will be upgraded, right? If you can understand what is going on with the S&P 500, then your trading skills will be upgraded. From my point of view, this is the most important index or indicator. I mean, you can put on your screen, on your chart, the moving average, Fibonacci, all kind of things, all kind of indicators. But the most important indicator, from my point of view, 90% of the time, is the correlation between the US dollar and the S&P 500. All right. So again, if we take a look on the S&P 500 and the euro dollar charts, we can see almost 95% match between changes of the momentum, right? Here we can see the same bottom, right? Here, here. Then we can see a change in the momentum, and then we can see the euro dollar slides. Sorry. All right. Here we can see the euro dollar slides, but then the S&P 500 is stamping, actually. It's not doing anything significant. And then again, the S&P 500 falls, euro dollar falls. Again, here, see the bottom. So the point is that you can see here almost a perfect match between the movements of these two instruments. All right? Again, that is because there is a strong correlation between the S&P 500 and the euro and the US dollar. All right? Great. So let's take a look here on 1 hour chart. So if we said that there is a negative correlation between the S&P 500 and the US dollar, it means that the US dollar is getting stronger when the S&P 500 is getting lower. So here we can see that the S&P 500 started to fall, all right, and the US dollar started to rise against the Swiss franc when the S&P 500 started to fall, all right. So here we can see that the breakup here occurred only when the S&P 500 started falling. This is a perfect example for timing a trade. Okay. The beginning of the trading session of the S&P 500 here is actually this time period. Right here and here it's the same time, because this is midnight and here it's not midnight, it's something like 8 a.m. Okay, so again, once again, here we can see the S&P 500. Sorry, here we can see the S&P 500 not doing anything significant. All right, we can see it stamping. Again, here we can see the pair stamping. And when did it start falling? When did it start falling? Again, when the S&P 500 started to make significant movement. So as soon as you spot, as soon as you recognize that there is a breakup of the S&P 500, then you understand that something is going on with the pair that you are trading, and vice versa, as we can see here. All right. So I hope that by this time you already realize that the S&P 500 has a great influence on your trading. So last thing that we will discuss is how does the correlation influence on exotic pairs or cross pairs. So if you read the daily analysis, SunBird daily analysis on daily basis, you know that when we start analyzing a cross pair or exotic pair, we analyze each currency against the US dollar separately. So for example, if I want to analyze euro versus the yen, I will analyze euro versus the US dollar and then the US dollar versus the yen. All right? We need to understand what's going on with each currency separately against the US dollar. Then we can come up with conclusion regarding the exotic pair. All right? So when you analyze a pair, analyze each currency against the US dollar and then try to realize which is relatively stronger. All right? Then you will have a better indication regarding the pair. And once again, the correlation influences the US dollar, which means that it's going to influence any exotic pair, cross pair, whatever you want to call it. So, for example, as you can see here, a strong session, all right, in the U.S. stock markets might push the euro up. Not these days, but usually 90% of the time, strong trading session in the U.S. stock market usually pushes the euro up against the US dollar. This will eventually occurs in any euro pairs, right? Most of the pairs will trade according to the euro direction. So you need to mix all of this information when you analyze the pair. You need to understand what's going on with the US stock markets and then with the US dollar, and then you need to analyze the exotic pair. All right. So let's summarize everything we've talked today about. All right. So analyzing the US indices is something you need to know before you analyze currencies. All right. Before you approach currencies, you need to know the direction of the S&P 500. You need to know its momentum. All right. This is the key. Second, you need to figure out what is the current correlation. As I mentioned, sorry, the current correlation between the S&P 500 and the euro. Actually, there is no correlation. The euro falls no matter what happens in the stock market, right? So, but you need to figure out, for example, the pound, right? The British pound still have currency mix up. You need to figure out each currency. That's it. Basically, this is the end. Thank you very much. it was clear to you. Very important for you to understand. If analyzing the S&P is new for you, I highly recommend that you read our daily analysis, and it will give you great tools for knowing how to implement this correlation thing. All right. Okay. Any questions? All right. So thank you very much, and see you on my next webinar. Goodbye.